Hello and welcome to Market Domination. I'm Julie Hyman and that's Josh Lipton live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
So I don't think that a higher than expected payroll number will move the needle for the Fed and cause them to be more apprehensive about rate cuts. What I do think could make the Fed more apprehensive is a higher than expected average hourly earnings. That is the metric that is most important to me in that Friday jobs report.
The AI train is moving full blast ahead, and obviously the people who are most directly associated with that, I think, are going to continue to benefit. 2023 was a year of experimentation for Gen AI and businesses. 2024 is the year of implementation.
What we're starting to see now is an improvement in general merchandise in Target's business, and I think perhaps an improvement around tone for the broader consumer generally. So I think that these are some pretty bullish signs for Target and for the U.S. consumer.
We've got 1 hour to go until the market close, and we want to show you where we are and how we got here. Taking a look at the Dow now, we're down 0.7%. For the S&P 500, it's a drop of about 1/3 of 1%. The Nasdaq off about 1/10 of 1%. But going back to the S&P for a hot second, of course, this is the first trading day of the second quarter, and we're coming off of a very strong period for the three major averages, none more so than the S&P 500, which rose a little more than 10% in the first quarter. It was the winner of the three majors here. A little bit of that momentum being stalled out today. Among other things, investors had to consider a couple of manufacturing reports from S&P Global and from ISM, both of them showing expansion in manufacturing last month. At the same time, however, the prices were on the rise. So a little bit of good and a little bit of bad in those reports. Looking out across some other asset classes that we're watching here today, in the wake of those reports as well, we see a move upward in yields. That's something that also could be putting pressure on stocks. That 12 basis point increase is a large one. Oh, and I got a little lost here, so we're going to switch on over and take a look at what's going on with the sectors in the S&P 500 today. Not surprising here that with those yields higher, real estate is the worst performing group here. Healthcare, consumer discretionary as well. Energy, though, is the leading group as we've got oil prices on the rise today. Josh, what about a stock name that we're watching?
All right, well, Julie, I'm watching a few chip makers here. Marvell, Micron, and AMD. Team at Bank of America says the three companies could benefit from that rising AI tide. Micron, by the way, was especially interesting. B of A's price target on the memory maker goes up to 144. They see strong growth potential for HBM, that is high bandwidth memory products. Basically, in layman's terms, this is super high speed memory that sits on a data center GPU, very fast, low latency, critical to AI. Team at B of A expects demand for HBM to grow at a 48% CAGR between 23 and 27. And for Micron, they think to expand its share to the mid 20% range versus 5% currently, helping, they tell their clients, drive record overall company sales.
You know, something that we've talked about before when it comes to the chip industry, and in particular memory chip makers like Micron, very cyclical business. What happens is a new memory chip cycle starts. The memory chip makers produce like crazy and then end up with too much. Now, what Bank of America is saying that this time could indeed be different because of those high bandwidth memory chips, because of the huge demand that is required for them because of AI. So that's what's interesting here and kind of the point of differentiation. One other story, by the way, that caught our eye today is a report in The Information, which is a tech news source, that says that Microsoft and OpenAI are planning to invest as much as $100 billion in a data center that will run AI software. Now, this is just a staggering amount of money if it does indeed prove to be the case. And it's one of the other things that is fueling some of these chip making gains today.
Wait, listen, if it was true, it makes sense that the chip investors would be very interested because just the mess of GPUs and memory chips and servers you would need. But that would be a truly remarkable number if that's true. Just to put that in context, Barron's pointing out that would be Microsoft's total capital spending over the past 4 years combined was about $104 billion. So just to put that number in perspective, we'll see.
Yes, we will see. We'll keep on that. Well, after starting the year out strong, stocks have kicked off 2024's second quarter in the red. But with a big week ahead, investors' focus shifts to Friday's jobs report. That will serve as another important signal to the Federal Reserve. For more on that and what to expect in Q2, let's welcome in Emily Rowland, John Hancock Investment Management Co-Chief Investment Strategist. Emily, it's great to see you. Thanks for being here. I want to start off with the little bit of economic data that we got today and kind of frame how we should be thinking about the data then heading up into Friday's jobs report. As I mentioned, we got those PMIs today, measures of manufacturing, better than estimated, or at least expanding, but prices going up. So what does that tell us kind of about where we are and where the Fed is?
Yeah, thanks for having me, Julie. Nice to see you as well. That was a big data point this morning. ISM manufacturing now back into expansionary territory for the first time since 2022. We've been getting similar reads on things like the U.S. leading economic indicators, which jumped to positive territory last week, again, for the first time since 22. So we are seeing this modest reacceleration in the economic data, particularly, of course, on the manufacturing side. And that's causing all of us cycle-based investors to kind of extend our late cycle investment call here. We're kind of in this never-ending period where the lagged impact of Fed tightening just has not tipped us into contraction. So we think investors should be thinking about how to position for that. But of course, this backup in bond yields, 12 basis points on the 10-year, about 8 on the 2-year, is really kind of shifting the narrative, and markets might not be celebrating so much anymore if it looks like the Fed's got to remain on hold.
What are your expectations for the Fed, Emily, though? When do you think they can start cutting? Ed Yardeni now, I saw in a note to his clients, he's thinking his base case is still 2 cuts. But later in the year, Emily, he's seeing November and December. He also told his clients, though, listen, he wouldn't be surprised if you get no cuts this year. Well, how are you all thinking about it?
I'd say that wouldn't totally surprise us either. I was hastily refreshing the CME Fed Watch tool after this morning's manufacturing data, and the market is still pricing in a cut for June and 3 cuts over the course of this year. The probability of a June cut went down a little bit, but that's where the market odds right now are. And in our view, I think it's going to be tough to make the case that the Fed can start cutting in June. You've got, again, prices paid, Julie mentioned in the data this morning, elevated. We'll find out how wage growth looks in the jobs report on Friday. But if inflation continues to be sticky, it's taking a while to get down to the Fed's 2% target here. We've seen progress on disinflation sort of stalling over the last few months here. We think that rate cuts may be later in the year. Now, one thing that's a little bit different than what you may be hearing is that once the Fed does start to cut, we think those cuts are going to be a lot more severe than investors anticipate. In fact, if you look back at the last 5 Fed rate cutting cycles, the Fed cuts on average 17 times. Usually there's something wrong when the Fed is cutting. So that's something that we would be thinking about as investors today.
Emily, will that finally be the thing that rattles the market? I mean, we got stocks off a little bit today, right? Not really anything meaningful. And I was going to ask you what you think would be the thing that would unsettle the market in a more decided fashion. Would it be the realization that the Fed is maybe going to cut more deeply?
I think so, Julie. And what you've seen starting in the fourth quarter of last year is really this pivot party that we've been talking about, this idea that inflation's coming down. Chair Powell's been quite dovish, and you're seeing markets react positively to that idea. And as that gets challenged more and more, we think that that could create volatility across stocks. I mean, Q1, though, was pretty amazing. You saw the 10-year up about 32 basis points, oil prices up 15%, and yet the market really shrugged it off. It was pretty tough to keep up in this market in the first quarter without taking a ton of risk. So I think the question becomes, how much of a backup in interest rates can markets handle? And certainly if today's any indication, and again, I guess this is like the new market correction, right? I mean, it's barely anything, but we've seen almost no volatility. And I think volatility could be coming back into the forefront as we continue to see this chop in rates.
Emily, selling may and go away. I think we can get ready to hear that pretty much nonstop. I'm just wondering how much weight you put on that.
Yeah, not a lot. I mean, we tend to use Fed policy, inflation dynamics, economic cycle analysis as sort of the key inputs. And, obviously we've got a big election coming up this year as well. So there's probably going to be some volatility around that. Things look fine right now. Earnings are kind of just good enough. I've been saying they remind me of my 8th grade son's report card. It's like not that great, but it's certainly good enough that he's still on the lacrosse team right now. And you're seeing, again, economic growth is picking up a little bit. The concern here, though, is inflation. If we continue to see commodity prices move higher here, again, I think that could create a challenge to the inflation narrative and cause the Fed to remain on hold, which stocks probably don't love.
Wonder what the lacrosse team is in that analogy. But in any case, Emily, so what does all of this mean for strategy? I mean, something that stood out to me from your recent note is that right now you're seeing an interesting connection of momentum and quality that is probably relatively unusual. So A, what does that mean? And B, how do investors take advantage of that?
Yeah, so the momentum factor rewards stocks that have been up over the last 6 to 12 months and it loves low volatility environments. What we have seen, and you want to be careful with momentum in isolation because it can often cause investors to get whipsawed. But right now we're seeing this marriage between momentum and quality. Quality is one of our favorite factors. It's companies with great balance sheets, tons of cash, low interest burdens, more stable earnings. So we want to be there. But frankly, the poster child for quality is mega cap tech. We still like tech, but it's pretty hard to argue that it's not overbought. The S&P 500 growth index right now is trading at a 45% premium to its long-term average. So we want to fade that in some respects and look to areas of the market that have less valuation risk. Mid-cap equities are on sale relative to their large cap counterparts. Areas like healthcare are trading cheap. And we also think energy deserves a look in portfolios amidst this pickup in economic growth, stronger demand out of China, and this kind of growth impulse that we're seeing right now permeating markets.
Interesting stuff, Emily. Always great to see you. Thank you.
You too.
We're just getting started here on Market Domination. Coming up, it's the newest edition of our series, Goodbye or Goodbye. We'll get investor insight on 2 stocks to help you make the best choices for your portfolio. And Fusion Energy Ventures has attracted more than $6 billion to date. Akiko Fujita goes inside a fusion reactor for our latest episode of Next. All that and more when Market Domination returns. Let's check in now on a few of our top calls of the day. Shares of Walgreens Boots Alliance down, giving back post-earning gains from last week. Analysts remain concerned about the drugstore's outlook after it narrowed guidance for fiscal year 2024. One analyst from Jefferies, for example, lowering the price target on Walgreens to $19 from $22.50. Now, I wasn't here last week, Josh. Maybe you can explain this to me, but the company came out, and me kind of looking back at the earnings report, it did look pretty negative. The commentary, they talked about a challenging retail environment. They narrowed that range for the forecast. They said it was a weaker than normal respiratory season. I guess that means like colds and allergies. But the stock did go up by 3%. And then today, you come in and you have a lot of analysts saying, it wasn't so great.
Yeah, I didn't see anybody changing their investment recommendations. I think we did see some folks, cutting their targets a bit. And I guess there was just expressing different concerns. Raymond James, they said the second half EPS run rate, they kind of crunched the numbers. Okay, we now think that implies a weak 25. True is saying the weak consumer backdrop is kind of impacting their ability to drive healthy growth and earnings performance improvements. So I think they basically looked over the earnings, took the weekend and decided some trends and themes they didn't like the look of.
And by the way, the stock is already down more than 40% over the past year. Just one other quick headline that I noticed here, Bloomberg picking up something in one of the filings for Walgreens, saying that the IRS is looking for $2.7 billion in unpaid taxes from the company. Now, again, that was out, it sounds like the other day in filings as well, and this is something that Walgreens is going to dispute, so it could take a while, but just another piece of data.
Yeah, certainly more noise for sure.
Yeah.
And let's move on here to Apple, down a bit today with Loop Capital lowering its price target on the iPhone maker to $170, projecting that Apple's annual revenue will decline in 24 and that iPhone demand is too soft. So more not so great news for Apple, Julie. So crew at Loop Capital, they do cut down to 170. I think the money line is here. iPhone unit shipments, they say, are simply too soft, owing to both organic demand but also competition. For the first time in years, they say, Apple is experiencing flattening iPhone ASPs, meaning average selling prices. Firm is still at a neutral on that name.
Yeah, I bolded those two sentiments as well from the note. And in particular, they talk about the competition from China, in particular, what's going on there with Huawei, and that those phones are really gaining more traction. And that is the issue, they say. They also ask, could iPhone average selling prices and mixed capacity growth be peaking right now, which I think is a really intriguing concept because, Apple, yes, of course, the iPhone number of units has been growing, but what really has set them apart is the margins that they collect because of the price of the phones.
Margins have held in there.
Yeah, and if the prices are not going to go much higher, then that is potentially going to be a problem.
Yeah, stock's now down about 12% so far this year. Finally, Jefferies releasing a new note on Alphabet, saying the company has some challenges when it comes to AI and management. So this is from Brent Till over at Jefferies, Julie. The stock's actually in the green this year. In fact, it hit a record high today, but it is trailing, peers and the indices. And one key concern, as Brent points out, has been Gen AI and the potential long-term impact on that company's bread and butter search business. Brent's basically saying, he's looked at kind of where they are, where they're headed, and frankly, he thinks this company has the goods for a full recovery. In his opinion.
I feel it feels a little yearbooky. He calls it most underrated.
Yeah.
When he talks about Alphabet here, he likes Microsoft the best. And as the note repeatedly emphasized, it's more than 220 pages. They really they go deep into AI. I'm not going to tell people that I read all these 220 pages, to be perfectly honest, but he does make some interesting points here about owning a basket of these AI stocks, and he offers some other ideas in that basket, sort of in different subsectors like security, where he talks about CrowdStrike, Palo Alto, Cloudflare. So the basket is pretty comprehensive to try to capture the upside that could be coming from AI. The other observation that he made that I liked, where he talked about if 2023 was spent asking questions about AI, 2024 is about finding answers, he says.
Yeah, I mean, we've had bulls come on the show, and they basically largely emphasize, I think, in part what Brent's talking about, which is this company should be well positioned. If you just look at the talent, Alphabet specifically, just the talent. Nobody has more data, and obviously a whole mess of users all around the world.
Yeah, exactly. Well, let's talk more about Google, the Magnificent Seven, the AI idea here. Let's bring in Lou Bassanese, who's Public Ventures President and Chief Market Strategist. So you just heard what we were talking about here, about sort of where we are in this opportunity. And it feels very sort of fits and starts still.
Agreed.
So how should investors be thinking
We should be
about
able to just put it into ChatGPT and get the answers, right? I mean, that would be just that simple. But
well, except ChatGPT makes some mistakes, which is sort of the whole problem.
And I think that's what last year was the year of NVIDIA and like the launch of the big AI wave. And this year's got to be about first derivative opportunities. Where are the tools and applications where AI really changes things for business, for consumers, in the medical field? And I think you're just starting to see some of those applications come out. From the software side, I agree that you have to play a basket. You're not going to be able to pick a single horse in this AI race and work out as well as it did for NVIDIA last year. I mean, let's just face it. NVIDIA can't have the same run this year as it did last year. It just would become too big of a company. I love Microsoft. Personal disclosures, I don't have any. We don't do any investment banking with them. But what I love about Microsoft is they can drive AI adoption by pushing it down into their products. Whereas NVIDIA is really looking to get pulled into the market by people that are developing applications that need their chip. So I think they have a little bit more leverage there than most players would give them credit for.
We actually just had Dan Ives on Wedbush on the show, who his survey work was talking about, very bullish on Microsoft too, was kind of talking about, at least his checks indicate more adoption of Copilot there. What about Apple, by the way? We were just kind of talking about it. I mean, it's down about 12% this year. And you can understand the sentiment there, Lou, because it's questions about the AI strategy, it's China, it's being targeted by regulators on both sides of the Atlantic. But what are your thoughts on that?
Yeah, I mean, look, I'm an unabashed Apple fanboy, have been for a long time, but you probably remember too, we go through these waves of sentiment changes, and usually the bearish sentiment peaks during this time of the year. It's just the next iPhone upgrade cycle is not going to be as strong, average selling prices aren't, and then we get a surprise, right? Services revenue boost a lot higher than we expected. Their installed base is bigger.
How many times have you heard the death knell for Apple?
Oh, I mean, all the time, right? It's innovate or die, and I've always said it's just iterate and thrive, because they have such a big installed base that if they have incremental improvements to margin, to product offerings, it really adds up to the bottom line, because they're always buying back shares and boost the profitability. So look, I'm always the contrarian. If we had the yearbook adage there, I would be the most likely to be contrarian. I like Apple when everyone else hates Apple, and I don't think it's anywhere close to being rotten right now.
Okay, so let's ask then about Alphabet and the sort of mixed sentiment that we have seen over their launch of their AI products. I mean, there have been a lot of questions, and that's been very volatile also.
And I think if you look at them in cloud services, right, they're the third horse in the race, right? They had great growth last quarter, about 26% growth for their cloud services, but it's only about $9 billion, which puts them 2.5 times behind Microsoft and well behind Amazon. But I do like Alphabet because they're really an economy play, an advertising economy play. And if we look at the underlying strength in the economy, it's really good. So that should boost their ad business, which I think if you look at the valuation, Alphabet's selling at the cheapest valuation out of the Magnificent Seven. I mean, about 22 times forward earnings. That's, if you want to, I think earlier in the show you're talking about valuations getting stretched with the previous guest in the tech space in particular. This is the undervalued name in tech for sure. I won't go near Tesla. I don't. Yeah.
Why you wouldn't go near Tesla?
No, I just think it's too volatile, and I think Elon Musk has always been a great promoter and visionary to say, here's what's next. I don't know what's next right now, right? The AI.
He himself has said we're between growth waves.
Yes,
is what he
and I think that's
it.
accurate, right? You get credit and the most valuation on the early phases of that growth wave. It's the S-curve of innovation, and they're looking for that next jump.
And you don't think, Lou, though, I mean, the way the stock has been hammered this year, you don't think all the bad news is priced in?
I think no, because I think the bad news is more to come, not just for Tesla, but for the whole EV industry. I think there's just a reckoning of the economics, and I think investors are trying to figure out where does that sort out.
All right. Lou, thanks for your time today.
Thank you.
Appreciate it. All right, stick around, because coming up next is the newest edition of our series, Goodbye or Goodbye. Lou and Julie are going to dive into 2 stocks to help investors make the best choices for their portfolio. Stick around, more market domination right after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're breaking down investing plays when looking at valuations. Let's bring back in Lou Bassanese, Public Ventures President and Chief Market Strategist.
Good to see you again. Long
yes,
time.
Exactly. So let's get straight to your buy here. It's the iShares Russell 2000 ETF, also known as the IWM. We've already seen a pretty good climb here thus far this year, so let's get into it here. I mean, that's come after underperformance.
Yeah, tremendous underperformance. I mean, do your own diligence here, but this is a great way to play the whole basket of small cap stocks. You saw on the chart there, had a historic rebound off the October lows, is now trading in line with large caps since that time, which has been something that hasn't happened for a really long time. It's breaking out from that perspective. So both up from the bottoms, large cap, small caps about 25%.
So dig into that a little bit more in terms of technically what you're seeing there and what it signals.
Yeah, I'm usually a fundamentals first guy, but you have to pay attention to the technicals. And when you look at it, all the technicals suggest that this price action is going to continue. So you've got the index itself trading above the 50 and 200-day moving averages. A lot of components in there are from the biotech space. So we're seeing a rebound in biotech. That's getting captured here in IWM as well.
And then finally, just getting to how it's priced versus its history. And for that, we actually have a chart we want to look at that illustrates this a little bit further. So just to show people what we're looking at here, the S&P 500 PE is in purple. The Russell 2000 PE is in blue, and then these dotted lines represent their averages.
They're long-term averages, and you see it's kind of like a gator's mouth opening up, and I'm a UF alum, so I'll just go with the gator chomp. But what we see is a reversion to the mean here. So if you're looking to rotate out of expensive things and buy cheaper ones, small caps represent that. And if we look historically, when they've rallied the most, coming off of these big disconnects, you've seen gains in excess of 100, 200, 300% and multi-year runs. So not guaranteeing or saying that's going to happen this time, but the setup's right. It's compelling, and a lot of people are starting to finally pay attention.
Yeah, certainly we've talked to a lot of other investors who like small caps for at this point in the economic cycle as well.
Right.
That said, it's not without risk. As you know, we always like to talk about what's the potential risk here. And it's that, interest rates are not really coming down.
Yeah, they haven't come down yet. So you said it, economic cycles have a big impact on small caps. So if we see some jobs data that convinces the Fed to hold rates higher for longer, or God forbid, actually inflation picks up again and reaccelerates and the Fed thinks about raising rates again, that would put a damper on this rally for sure, because small caps tend to be the most sensitive to economic changes.
And do you have a position in small caps?
I do I personally have a position. Family has a position. Our firm does not. We don't do any banking for an ETF. So.
All right, let's get to your goodbye out of here. And this one is Reddit, which is really interesting. And this looks like a long-term chart, but it's not, because Reddit just went public, had a spike, but then has since come back down. So what's going on here? You don't think they're going to make any money?
No, I mean, 19 years running and not a single profit. They got over $800 million in revenue. Look, when you buy any company, it's for the future profit potential. And I don't believe there's any here. And the history proves that out. So got a long way to go to turn that corner. 90 million in losses in the last year on 804 million in revenue and tons of R&D spending.
Now, it's interesting, your next point here, because you point out that they don't hold any patents. Now, Reddit would probably argue, and has argued, that it's the community that they've built.
Of course.
That's where the value
When
lies.
you don't have patents, you talk about other things, right? Look over here, not at the patents. But if you look at Snap, what's forever doomed Snap from ever catching up to Meta is the fact that Snap never had real patents on their portfolio, whereas Meta has tremendous patent portfolio, and that's allowed Meta to rip off anything Snap innovates and implement it, and they have a larger network. So Reddit suffers from the same fate. In fact, they're actually being challenged by Nokia on some of their IP that they may be infringing upon. They have one patent application. That's really not going to get them anywhere. So in my view, in our firm's view, you have to have the patents to own the marketplace, and they just don't have anything.
Interesting. There. All right, and let's talk about the valuation as well. You say it's extremely overvalued, and let's compare it to some of the peers. You mentioned Snap a moment ago. So if you're looking at price to sales ratios, which if you're not making any money, you have to look at a price to sales ratio.
Yeah. There's no earnings to compare earnings multiples. The only thing that would be more expensive here would be True Social and DJT. So we're looking here that Reddit is trading on par at like a 9 times price to sales ratio, which is on par with Meta. And there's worlds of differences. 3 billion active users and under 100 million. wildly profitable, no profits. Even if you put it in a class, Pinterest is the most direct comparable, still can't stack up on any level from a price to sales, profitability, and average revenue per user. So I think Reddit is coming into a crowded space without very much to distinguish itself from the rest.
Well, let's talk about the one thing that Reddit has really talked about as its selling point here, besides the community thing, that could be the potential fly in the ointment for your bear case. And that's the, kind of selling their data to train AI.
Yeah, look, I've been wrong before, so this could be the reason I would be wrong. A $60 million deal with Google for AI services, it's a fractional amount of revenue, but if everyone latches onto this, we saw this through the COVID days, it becomes a meme stock, everyone gets behind it, they don't invest in the fundamentals, they invest in the hype. That's what could work against you here.
Gotcha. And do you have any position in Reddit?
No positions in Reddit.
Okay, gotcha. So let's summarize what you are telling people, Lou. You're saying buy that iShares Russell 2000 ETF. Small caps, you say, are now trading as well as the large caps. They're fundamentally compelling, and even more gains could come if you look at history as well. On the other side, you say, stay away from Reddit. It is extremely overvalued, has nearly no chance of ever making any money, and you say it's doomed without patents. We'll see what happens. Lou, thank you so much. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
Time now for the day's trending tickers. Let's start with Tesla here. Shares riding lower as it raises prices on all Model Y vehicles. So in the U.S., prices go higher on its popular Model Y SUV by about $1,000. Did the same in China with the Model Y long-range version. Price hikes not a surprise, Julie. These were telegraphed, so we knew this was coming. Maybe Elon Musk trying to move some vehicles ahead of that Q1 close. Of course, this comes at a time we know when Tesla's competitors, U.S. and China, have been cutting prices, which is interesting.
I mean, and these price hikes are not very large, right? They're just around $1,000. The other thing that really people are watching for Tesla right now is finding out the deliveries for the first quarter. That's what everybody wants to know. What do the numbers look like? Especially at a time when Tesla's already not performing very well. We just talked to Lou Bassanese a few moments ago. He said he would not touch Tesla at these levels because it is in this sort of in-between time, and he doesn't see what the next catalyst is going to be.
Yep, fair enough. Well, let's bring in Yahoo Finance's Praz Subramanian for more on this. Praz, what can you tell us?
Like you said, that those price hikes were not unexpected. They were going to happen. Tesla's U.S. website had these, that it'll go up by $1,000 at the start of the month because, as you know, they wanted to push those late quarter sales. But you actually noted it tomorrow as we're going to have those delivery numbers coming out for Q1. That's what everyone's a little bit on edge about. Bloomberg consensus around 453,000, 454,000 for the quarter, which would be down 6% compared to Q4, but then up a decent amount compared to a year ago. The big concern is if it actually is below that 422,000-ish from last year. If that's the case, and some are predicting, like Deutsche Bank's predicting that could be a big downer for the stock, I think, tomorrow. So that would indicate some reasonable concern there for China and the U.S. and wherever else.
And it was interesting what we heard Lou saying, that there's what's next for Tesla. He wants to know that, and at this point, with Tesla sort of, the bar maybe is a little bit lower than it was for Tesla because they have set the bar low and tried to manage expectations. But, it's kind of like, where's that next excitement coming from?
Yeah, I mean, it has to be the Gen 2 vehicle.
But that's not for a while, Roz, right?
That's not going to be in production until 2025,
right.
But they're supposed to reveal this vehicle sometime this year. I think that's a big step that people want to see. They want to hear more about, are we going to have another battery day or an AI day to explain what they're up to in that regard, and a bit more information on those types of long-range side bets that are actually kind of propping up a big part of the value. So I think that's sort of the things that some of these analysts want to see. But I think from my point of view, from the car business point of view, can we see that Gen 2 vehicle sooner rather than later? We know it's coming out next year, but can we see it? Right. That would be a big, I think, positive for the stock.
Well, and I had a benchmark for myself. I saw the first Cybertruck on the road. I was just on vacation. I saw it on the road in Miami, which makes sense. It looked like it had a special paint job. It was all black, unless that's how some of them come. I don't know.
Yeah, they're offering a vinyl wrap, these wraps you can get from the factory. Green, black, whatever.
It was like a matte. It was like a matte black. It was interesting. And I had to do a double take. I saw it on the road, I was like, what? Did
it change your mind on the Cybertruck? Were you like, okay, now I'm in the matte black version?
No, I mean, we just kind of looked at what is that? It's just sort of silly.
I haven't seen it actually, but I heard it looks a lot longer than you think, right? Is that was the kind of appearance you
I actually felt it looked smaller, like it looked more like the size of a regular SUV. It's just this odd
I think
shape.
a beholder prize. That's all it is.
But I don't know. It was brief. It was a brief glimpse. I don't know. We'll have to do
Miami got a lot
more
going
research.
on. You get a little distracted.
That
there,
is
so.
true. There weren't women in bikinis hanging out the windows, but well, next time. Thanks so much, Ross. Well, let's take a look now at a very different story. 3M, the company announcing its completion of spinning off its healthcare business Solventum, which is going to join the S&P 500, by the way. It's up 2.5% today. 3M up by 5.7%. This was previously announced. We knew that this was happening, that it was effective
This is just this is the official approval.
Yes, exactly. This was planned back in 2022, but finally has happened as we see the de-conglomeratization, I guess, of you had GE that happened with, you had 3M that happened with a number of other companies.
Yeah, so I mean, on the suit, it sounds like this settlement just basically means 3M can avoid what I would assume would have been just years of court fights with utilities that say 3M is kind of liable for the damage they're going to have to deal with from these so-called forever chemicals, and for investors a measure of clarity there too. And then to your point, also this news that they're going to spin off the healthcare business Solventum. That was also another headline.
Right, exactly. So in terms of this, the settlement that you talked about, 3M had proposed $10 billion that it would settle all of these claims related to PFAS, or so-called forever chemicals, that were coming from 12,000 public water systems across the U.S. So the court now has approved that settlement, but the litigation is not necessarily finished because there are individual suits as well. But this does sort of end one overhang, I suppose, for the stock, and could be another reason that we're seeing it go higher today, for sure.
Finally here, Trump Media and Technology Group taking a hit after an updated regulatory filing shows the company taking on heavy losses. Shares are plunging in today's trade. They're down about 21% right now. So day in the red there. The filing basically says, Julie, okay, Trump Media reported sales of about $4 million with net losses of about $60 million for the full year ending in December. Company, and I think here was the key here, company says it's going to continue incurring operating losses and negative cash flows from operating activities for the foreseeable future. As it says, it's going to work to expand the user base, attract more partners and advertisers.
Yeah, I mean, that revenue number at $4.1 million was up from $1.5 million back in 2022, but was down 39% year over year. Yeah. I mean, it just emphasizes, again, that this is not a real business that people are investing in it. People are buying the shares because they support Donald Trump's re-election campaign, or him as a personality, or whatever you want to say. I mean, it's a meme stock. And so it's interesting to see it pull back on actual fundamental news, unless it's just sort of trading around this event, or I don't know. This is another one of these sort of confounding one. Matt Levine over at Bloomberg wrote about this in his column today and said, maybe fundamentals don't matter at all. Maybe cash flows don't matter. Maybe all that matters is that this company has name recognition and people are going to buy it for that reason. I don't know.
He does, and former President Trump does have obviously a big stake in the name. And so there's been a lot of talk about the lockup as well.
Yes.
And there was some news on that in the filing this morning too. Our friend Corey Johnson over at Futurum pointing out that if the stock is still above 12, they can sell in about 5.5 months.
But he did not get a waiver to sell his shares earlier, which had been a question. And by the way, a lot of the net losses appears, according to CNBC, to come from $39.4 million in interest expenses, which is an interesting thing there. They must have some debt that they are paying interest on. All right, let's talk about AT&T finally moving as well. Under pressure, although less than earlier, after the company addressed a data breach. Information for current and former customers recently released on the dark web. Not just for current and former customers, we're talking about 73 million current and former customers. The company is currently resetting 7.6 million account passcodes. And AT&T is the laggard among big telecom over the past year by a pretty wide margin.
Yeah, I mean, it's been a rocky start to the year for AT&T, because remember in February, Julie, we were talking about there was that big outage, took hours to resolve, federal government investigated, so a rough start in 2024 for AT&T.
Yeah, well, coming up, we're going to talk more about telecoms and how to play them. In fact, in the Yahoo Finance Investor Playbook, we're looking at how to navigate that communication services sector that those telecoms are a part of. It's been a big outperformer, not necessarily with a lot of their help. We'll have more market domination on the other side.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Broader markets under pressure here, but gold hitting a new all-time high in today's trade. Jared Blickery joins us for more. Jared.
Josh, I'm looking at a high of $2,200.86 or $22.86.40. That is a high, a record high denominated in US dollars. And you can see it trading around $22.60 right now. And I'll show you a chart. Now, we started the day pretty high, and you can see we actually headed lower on that stronger than expected ISM report this morning. And this has important implications. And let me just kind of tie together all the market moves that I'm seeing right now. So we have gold at a record high, and usually you don't see that when you have the 10-year T-note yield climbing. But as I said, the gold move had already been made to the upside and it was climbing down. Now here's the 10-year T-note yield. This is up 12 basis points today. This is the largest jump that we've had in about 6 weeks. So this is significant. In addition, we are knocking on a multi-month high. Here's a one-year chart, and you can see we are right by the highest level going back to late last year. And if we were to accelerate up beyond that, that would probably mean traders are looking for that higher for longer trade, that the Fed will actually not cut it by as much as was thought. Now, here's another correlation. Small caps are down today, but just going forward, they might have a reason, you might have a reason to think that they'll go up a little bit more, not only because they have broken out of a multi-year range, but this also ties back to what was happening this morning with the ISM report. Here I have, going back to 1980, ISM manufacturing is in cyan, and you can see it's very closely tightly knit with the S&P 500 or Russell 2000 versus the S&P 500. So in the Russell, when small caps are outperforming, that happens when the ISM is turning up, and that's what's happening today. Suffice to say, there's a disconnect between what traders are thinking the Fed will do and the next move that we're seeing in the bond market.
Well, we'll see who wins that conversation. Thanks so much, Jared. Appreciate it. The communications services sector, it's a hodgepodge of stocks with names ranging from traditional telecom like Verizon, tech giants like Alphabet, and streaming services like Netflix. And the sector is one of the top performers during the first quarter, boosted by big names like Meta and Disney. But let's talk about where there are other pockets of opportunity within that group. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now is Brandon Nispel, who's KeyBank Capital Markets Equity Research Analyst. Thanks so much for being here, Brandon. I actually want to start you off with a company that had a little bit of news over the weekend, and it wasn't very positive for it. I'm talking about AT&T with the news that a number of its accounts had information leaked. It's now scrambling to kind of reset passwords, and it's already been a tough past 12 months for AT&T with the stock down 10%. I don't think you like it, though. Judging from your most recent note on the wireless industry, you wouldn't step in here.
No, we wouldn't. From our perspective on AT&T, they're a third place network and third place in terms of subscribers in the U.S. You know, I think you see the third place network manifest itself in the network outage that they had this year. You know, the data breach, which is driving the stock down today, we actually don't think that that's that big of an issue. A lot of that news was already out just a month or two ago. And so it seems like just the headlines are catching up to AT&T, but we prefer Verizon and T-Mobile in the wireless space.
And how come, Brandon? Why would you prefer Verizon and T-Mobile here?
You know, for Verizon, from our perspective, it's somewhat of a turnaround story on their consumer business. They've been losing subscribers in their consumer group for the last several years. They put a new CEO in place in 2022 who's made some operational changes. And now the company's expecting to return to positive consumer postpaid phone net adds in 2023. And all of that is leading to ultimately, a better EBITDA growth profile and really strong free cash flow for Verizon.
And then there's the other one. There's T-Mobile, which has been the winner over the past year in terms of its share performance, and also, both because of its merger, but also organic growth, right? That it's been the one that has kind of been now the second place player that was the third place player that has kind of caught up.
Yeah, no, absolutely. T-Mobile's been one of our top calls in the wireless space for a long time, and it's mainly a function of the organic growth of the business. They're growing EBITDA at high single digits, and we think that can continue. You can't find that type of growth in some of the more traditional comm services space, and all of that growth is really a function of them growing market share. They've had the ability to catch up from a 5G perspective after their merger with Sprint, and a lot of that integration effort is now behind them. So they've been able to capture synergies while also improving the quality of their network. which is a really good combination in our view.
And Brandon, for viewers who are listening right now, Verizon and T-Mobile specifically, what are the downside risks to your call there?
The downside risk is that they don't execute in terms of how investors expect. To the point on Verizon, Verizon has guided us to expect consumer postpaid phone net adds to turn positive. So you want to see progress on that throughout the year. Same with T-Mobile. T-Mobile, we think, is going to be a beat and raise type of story, and we think the stock needs it to move higher. And so for T-Mobile to just come in line, I think that would be a risk to our view there.
And then, Brandon, getting away from just sort of pure wireless providers and telecom providers, you also like Comcast here. And in a recent note, or I guess when you sort of came out with a recommendation to buy it, you called it a tech company stuck in a cable body. Explain what you mean by that.
Comcast has a lot of really interesting tech, whether it goes into the network. And I think their network is by far and away the best network in the business. There's a reason why companies license a lot of their technology. It's because Comcast has spent so much time investing in their cable network. And on the streaming side, I think you can argue that there's a mini trade desk in this business. There's a Roku in this business, which we think is pretty underappreciated by investors.
Do you like it better than Charter, Brandon?
Absolutely. As we look and compare and contrast the difference between Comcast and Charter, Charter's spending more capital upgrading their network than Comcast is. Ultimately, Comcast is growing free cash flow and has lower leverage. And those are just a couple of reasons why we like Comcast over Charter here.
And, you talked about that the market underappreciates these sort of other pieces that are within Comcast. Sometimes in these situations, you then get an activist to come in and say, well, you should spin it out so it's appreciated. What do you think is the catalyst to get the market to sort of realize the value of some of these internal businesses?
That's a really good question. It's one of the debates that we have often with investors. I think investors do want to see Comcast split off part of their media assets. Ultimately, I think what we want to see is some of the underappreciated assets, whether it's their Xumo JV, which is effectively like a Roku competitor. We want to see them monetize that better. We want to see losses on their media business, especially Peacock, improve. Comcast is tough, though, because it's a conglomerate. It's run by a family, or the family has majority ownership. And so it's tough to split those up.
Brandon, finally, I want to zoom out a little bit because we came into this segment describing how the S&P Communication Services Index, whose ticker is still TELS, reflecting its telecom roots, is so sort of diverse, right? It has these sort of new telecom or new comm services companies, old telecom companies. Do you think investors should still look at those as a basket and that it is a good time to buy the basket as a whole?
I generally don't take that view. I segment the comm services space between sort of the new tech and the traditional, and I cover a lot of the traditional names. And from my perspective, that's a space that you want to be relatively cautious on. You don't want to just buy everyone in the basket. So, Verizon and Comcast are two of the names that we really like in our basket.
Brandon, thanks so much for joining the show today. Appreciate it.
Thanks for having me.
Well, wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There we have the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended on the day. The Dow Jones Industrial Average up off the lows a little bit, but still down about 242 points here, about 0.6%. The S&P 500 also up a little off the lows, down just about 1/5%. The Nasdaq Composite actually finishing higher by about 0.1%. It was higher earlier in the session, bumped along in the negative for much of the day, and then eking out a small gain when all was said and done. What's interesting about this today is that, as I pointed out earlier, we've got a surge higher in bond yields today, 12 basis points on the 10-year, which is a big move, and yet large cap tech did okay, which is a far cry from what we have seen in the past. So this perhaps represents a shift, more comfort level with rates at this level. Maybe. We can't extrapolate too much from a single session, but when you look at this day, and with the exception of Apple, the largest of the large in the green here, even if NVIDIA was just up 1/100%, it's just an interesting thing to note. Even as we see a mixed picture by and large, the fact that you've got a Google trading in another record today, even as you see that big upward move in yields, is interesting to note. Jared's got a closer look at today's action as well. Hey, Jared.
I concur, Julie. I was looking at that price action not only in the mega caps, but also in gold. You usually don't see gold heading higher when you have interest rates jumping, but the over the last 24 hours, it depends on how you slice and dice it on an hourly basis. So we'll see where things settle in tomorrow's settlement. In the meantime, energy up the most today, followed by communication services. That is the sector that houses Alphabet and tech. And just thinking about Alphabet, just real quick here. This is the first record high we've seen since January, and this is completing a larger pattern of a cup and handle, and we're just accelerating to the upside. So we'll see if we get continuation there. We've seen a lot of that very similar chart action in not only individual stocks, but sectors. Now, looking at our leaders here, K-Web, that is a Chinese internet ETF, that finishes at the top spot, followed by chip stocks. So on a day where you have a lot of red, we're seeing a lot of green here. I don't think that's a record high for NVIDIA, but I'll leave you on another green screen here. This is the energy market. As I said, that was the #1 performing sector today, Josh.
And Jared, let's take a look while we have it here at United Airlines edging lower in today's trade. The news here, they're asking pilots to take unpaid time off next month, Julie. And apparently this could actually extend into the summer, maybe even the fall. And this is because the carrier is dealing with these delayed deliveries of planes from Boeing. So you need fewer pilots if you have fewer planes. Reports that United was going to receive 80 MAX 10s this year, part of this outstanding order with Boeing for 277 of the planes.
Yeah, and Boeing wasn't the worst performer in the Dow today, but it was among the worst performers in the Dow today, because obviously this is just the continued sort of drumbeat of negative sentiment surrounding that stock and the slump that it's seen, and now, of course, the impending departure of the CEO. So this is sort of just incrementally more negative news and more revelations about the ripple effect and how pivotal Boeing is for the airline industry.
For sure.
All right, markets kicking off the second quarter with declines across the board. The moves coming on the heels of today's manufacturing data. Let's bring in our Josh Schaefer for today's top takeaways, and let's start maybe with that manufacturing data.
Yeah, so if you look deep in that report, you really got kind of a mixed bag, right? At a high level, when we're talking manufacturing data and sort of manufacturing activity, it was one of the better reads we've had in a while. We saw the manufacturing sector overall for the ISM reading reach above 50 for the first time in a year and a half, which is a big denominator there. And then you also look, you see new orders picking up, production picking up. You saw similar in S&P Global's report. In some, we saw economic activity or the prospects of future economic activity perhaps picking up. Market strategists would normally circle that and say this is good for the economy in perhaps economic sensitive sectors. That was not really the trading action that we saw following it, which I sort of found interesting. And I think that's when you look at the other pieces of the report, prices paid in both of these indexes going up. And you talked about the 10-year earlier, Julie. We saw the 10-year rise at the open. It was rising before 10 o'clock, but that big move up in the 10-year really seemed to happen after we looked at the prices paid index in this ISM report. So to me, it was interesting just to see Michael Cantrell over at Piper Sandler pointing this out. It seemed like inflation sort of dominated the trade today overall, rather than maybe some of the positives we saw in the economic data.
Yeah, I mean, I saw Torsten Slok of Apollo. He looked at it and said, this is basically supporting my view of re-accelerating economic growth. Rates are higher for longer. I think Torsten is in the no cuts this year.
Right, and it continues that debate of whether or not no cuts would be good or bad, right? Because Torsten points out no cuts because the economy is re-accelerating, and I think there's sort of two sides to that argument, right? You won't get Fed cuts, but does the economy re-accelerate enough that it's actually a positive? I think you could sort of play both sides of that to some extent.
Well, and so when we look at inflation, and I noticed today Bloomberg flagging that the bets for a June rate cut briefly dip below 50%.
Yeah. Right.
But on the flip side, the PCE number for Friday was more benign. That we got on Friday when the markets were closed was more benign. So, what are you seeing? What are you reading in terms of how people are feeling about inflation?
I thought the S&P team made good sense of this, right? So they have a chief economist that comments on their own report. And they highlighted that they said it really just underscores the likely bumpy path in bringing inflation down to 2%, right? Sort of maybe just this realization that we've been talking about a lot here. Powell's talked about it, and it seems like more and more economists are starting to latch onto that word bumpy too, of just the trend is probably still there. That doesn't mean every print's going to be good, and it will just be interesting to see, I think, the market reaction as we move forward. Do we get consistently worried again if we get positive data, but it comes with the downside of maybe it's bringing inflation up, something that we'll probably watch on Friday, right? Say wages come in hot again. Are we going to freak out about inflation, or are we going to be excited that the economy is creating jobs? It's always interesting to see sort of what the spin is from data that can look the same month to month, but it sort of depends on what the prevailing narrative is.
Yeah. And then meme stocks, we got to talk about that. We got to talk about Trump media and telecom.
I mean, there's nothing more fun than just looking at meme stocks, right? If we're talking market takeaways, we might as well just take a look at meme stocks. So you see the Trump stock down over 20% there today. Guys, and I think the prevailing takeaway for me, obviously, if you look fully into the 8K, there was a lot of information there on how essentially this company has little revenue. They're losing a lot more money than they bring in.
Wasn't there a going concern mention in there also?
Yeah, basically, if you read it, you would be like, I have no idea how this company is going to ever turn to profitability. That was my broad takeaway, right, from sort of understanding the data there. And of course, the stock falls on that. And to me, it was just sort of a reminder of how these meme stocks really work. And it's not just the Trump stock, right? When we look at GameStop caught a bid about 2 weeks ago. We were tracking it, had its best day in a year, up 18% on Monday. Tuesday, they announced earnings. Stock tanks. Stock is now down over the last month. Take a look at Reddit. Reddit's now trading at $46. When that short report came out last week, it was a $75 stock. And really, all it seemed that short report brought to light was something that a lot of people have been talking about, which is just the fundamentals in the Reddit stock story might not be worth a valuation when you start getting that stock up to $75, $80. I mean, look at the chart there. You're seeing the stock now back even with where it opened. So I guess maybe my takeaway here is just a warning for anyone that's getting into these stocks to remember that you never know what day people are going to wake up and sort of start caring about the fundamental story.
Right. Yeah. I mean, the stock could have easily gone up today.
Oh, it could, right? And it will. There'll be, next week, we'll be talking about the Trump stock up 25% for some reason we don't know.
Yes.
Is it indicating, Schaefer, though, just more than the meme stocks, just how animal spirits are alive and well? Because you can go beyond the meme side. I mean, look at the moves, and we talked about in the show about Coinbase's move this year. You can talk about Robinhood this year. These moves are incredible.
Yeah, no, they are. And I think, Josh, to take that a step further, it would maybe be that we haven't reached peak animal spirits, right? Yeah. Because we haven't been talking about it. Seriously though, we haven't been talking about it for weeks on end of these stocks continuously going up to some level where it's like, oh my gosh, I can't believe it. We've been talking about it for 2 weeks that they keep going up. And when you think back to 2021, that was sort of what happened, right? It got, all of a sudden you could sort of wake up and realize, oh wow, this got really out of control. And we haven't reached that yet. So maybe the pullbacks are a good sign for market sentiment.
Yeah.
We'll find
Peak animal spirit. You need a name for that. Something catchy.
We'll work on it. We'll come back with that.
Thank you, Joshua. We move on. Disney's shareholder vote on the company's board is coming up on Wednesday, and the proxy battle between the company and activist investor Nelson Peltz is entering its final stretch here. Peltz now garnering support from CalPERS and Neuberger Berman ahead of that meeting. For more, we're now bringing in Bill George, former chairman and CEO of Medtronic. Bill, it is always good to have you on the show, and maybe we'll start there, Bill. I want your take on just some of the big names who are coming out, Bill, in favor of Mr. Nelson Peltz. So we can talk about CalPERS or ISS. What do you make of that, Bill? Are you surprised by that?
I'm disappointed, but I think they're looking for short-term gains, and they think somehow Peltz is going to come in and cut a lot of costs, but it'll leave Disney in the lurch. This has been a very costly, distracting battle. And by the way, Iger and Disney board have lined up a lot of strong supporters, people like George Lucas and Glass Lewis and others who have supported them, Jamie Dimon, of course, JP Morgan. So I think in the end, it's going to be a very close battle. But the point is, Iger's got a big job to do at Disney, and it's taking him away from getting the job done because Chapek left the company in a mess.
But was Iger, hey Bill, it's Julie here, but was Iger also getting a little complacent, a little arrogant, dare I say? I mean, was there any utility, even if Peltz doesn't succeed, was there any utility in this in getting, yes, I see the argument that it's a distraction, but is it also cause him to focus?
Well, it's caused him to accelerate, I think, that's for sure. And it's a big job, you know, and he's still got a lot of big issues he's facing. He had to get the situation right with Governor DeSantis and stop that war. He's still got the Disney Plus streaming. How fast can they convert from cable to streaming? There's no resolution yet of ESPN and ABC. I anticipate eventually they'll want to spin those off. And but the key is that no one ever talks about is Chapek centralized all the creativity, and now Bob is decentralized and getting it back to the people, and that's the only way to run a complex enterprise like this. So there's a lot of work left to be done, and then not to mention the fact by 2026 he's got to have a successor. So he's got a couple of years of breathing room there, but that's not been a good course for a long time for Iger and the board.
And Bill, you're touching right there on a central point here, which is this issue of succession. And I mean, you've seen, Bill, how, you know, the fans of Nelson Peltz, in part, that's what they're saying. They're fans of Nelson Peltz because they think he's going to join the board, Bill, and he's going to force the board to this time actually get it right.
Well, I don't know. I would think he, like a Unilever, he got in the wrong successor. He got in a very short-term person. And yeah, he'll get somebody that'll cut a lot of heads and do things like that. But Disney is, you know, this is an iconic company. It's a classic global company. They've gone for American. And by the way, it's a very strong board. And Iger's taken steps to beef up the board with the former head of Sky, Sir Jeremy Dalek, and Lululemon, and brought in they have a very strong board. Mary Barra, Safra Katz. You aren't going to find many stronger boards. They don't need Nelson Peltz telling them what to do. They know what to do. Mark Parker's done an excellent job as chair. So they don't need Peltz to get things going. They know the pressure's on them. They know they failed with succession the last time around, and they know they'll have to get it right. But it's the boards who want to get that right. That's not Peltz to do that.
Bill, out of curiosity, do you hold Disney shares yourself?
No, I don't hold any shares like that, so I can talk objectively to people like you. And when I teach at Harvard, I don't have a bias. So no, I don't hold any shares.
Well, that's helpful for us.
I would, you know, but, you know, for the long term, it's a great company. And I'm glad Iger's back. Bob did a fantastic job. He's one of the great CEOs of the last, 16, 18 years now. But the succession thing, he's a hard guy to replace, too.
Bill, I'll get you out of here on this. Bottom line, what do you think's going to happen at this shareholder meeting?
I think that Disney will eke out a narrow victory over Peltz. And Peltz can go away like he did on PepsiCo and a few others, that he can go back and find someone else to go after. At least that's I hope it'll come out, because I think it's the best thing for the long term for Disney. And this is a company that deserves a very great long-term future.
Bill, always love having you on the show. Thanks so much for joining us.
Thanks for having me.
Still to come, the FAST Act taking effect in California today. We're going to speak to a restaurant franchise owner about how the higher wages are impacting employment. More market domination over time coming up. The highlight of this first week of the second quarter is Friday's jobs report, of course, which will serve as another important signal to the Fed. And ahead of this week's data, we're already starting to see some states flash warning signs amid rising unemployment, or as some call it, the SOM rule. Yahoo Finance's Josh Schaefer joins us now for more. Joshua.
Yes, so we've had some economists applying the SOM rule, which, if we go through what the SOM rule is, that is normally a national recession indicator. So we would be talking about the 3-month rolling unemployment rate increasing more than 0.5% compared to the last 12 months for the SOM rule to click. What's happening here is that's happening in states. So it's happening in 20 states right now. This is highlighted by UBS's economics team. And what they said is, largely, you can't look at this as an actual recession indicator, but what their takeaway was maybe it's telling us that the economy isn't as strong as we think in certain areas of the country. What I found to be most interesting was I asked the founder of the rule, Claudia Sahm, about these findings and sort of what she found from them. And she said largely she doesn't really think this is an effective practice, because the 0.5% sort of trigger line in the SOM rule, in the traditional SOM rule that she highlighted, she only worked with that at a national level. So when you go and apply that to states, and you think about states that have seasonality, workers come in during the summer, and different factors, it just doesn't really work. She tried to do it herself after this research was coming out and said it was sort of a tedious task, and she wasn't really sure how to attack it state by state. But what she did find, perhaps the most interesting thing of this whole little exercise here, was the increase in immigration that we're seeing at a national level, and that's something people have pointed to. We just showed the unemployment rate going up to 3.9%. A lot of the talk has been about immigration increasing, right? And part of what you're seeing here is you can see immigration pulling up the overall US labor force. If they don't get work immediately, then your unemployment rate goes up. We're also seeing that at a state level. Claudia pointed out, if we go back to that chart where we're showing states that have high unemployment rates, the 3 biggest states are California, New Jersey, and New York. Those are also 3 of the biggest states from an immigration standpoint.
Right.
So those states are bringing in a lot of workers, and in some that could be part of why their unemployment rate is rising. And the kicker here would be, if that's happening and we're getting more workers, that probably means that supply would go up and overall the economy could actually grow more than expected. If you spin that all the way through, that's something economists are thinking about, this increase in immigration, is it actually could be a good thing.
Right.
Not to take that big chart and just say this is all a good thing. Of course, there are signs of weakness within that, but there is perhaps nuance here that I found rather interesting.
And it will also be interesting to see if some of that immigration disperses to the states where there are more jobs, but I guess that we'll just have to see.
Yeah, that was right. That was the other piece of it. And Claudia said they normally find that immigrants would go to places where other immigrants are, which is why it's so heavily in certain states. But yes, if you were to see them then migrate to where there's more opportunity, our imbalance of supply and demand, as we often talk about in the labor market, would perhaps come into better balance.
It might do that. Thanks so much, Josh. Appreciate it. Well, roughly 500,000 workers in California are getting a raise starting today. The state's $20 an hour minimum wage for fast food workers is now into effect. Chains with more than 60 locations nationwide are affected, and some companies plan to raise prices to offset those higher costs. Some also considering cutting workers. Joining us now is a franchise owner in California, Alex Johnson. He owns 10 Auntie Anne's and Cinnabon franchises in the San Francisco Bay Area specifically. Alex, thank you so much for joining us.
Thank you for having me.
So just tell us what happens today for your workers, and what are some of the changes you've had to make for the business as a result of this new law?
Yeah, you mentioned it briefly. We are having to raise prices, but this is truly something I don't want to do. We've had to raise prices several times over the past couple of years because of COVID-induced inflation, and we've seen declining sales and declining traffic counts because of that. And I really worry that we're going to get to a point where customers just will trade off, and they won't buy our product. They won't come to our restaurants anymore. And I'm really worried about that. We have team members who leave in our locations. We're not backfilling those positions. And in some locations too, we're just not hiring right now. We're making do with the help that we have. And ultimately, I worry that our service will be slower, and then customers won't be patient, and I'll lose more business because of these effects of this bill.
Would you, and Alex, you're in my native Bay Area there. I'm just curious, with this now in effect, this new law, moving ahead, Alex, would you open up a new restaurant in the Bay Area?
No, I actually just turned down a location which would have been a really great location at Pier 39 in San Francisco. Super high traffic, tons of tourists. This would have been a flagship location for me. It's a family business, our small business here that we have that runs these locations, and it would have been a huge point of pride for my family and I to have a location there. But we've actually decided not to expand at all in the state anymore. And I've actually, since the fall of last year, moved to Nevada. And I'm opening different franchises in that state and bringing those new jobs to Nevada versus in California.
Alex, the workers that are there who are getting this raise, I mean, is their morale better because they're going to be making more? Do you think you're going to be able to even get better performance from them because they are making a better living?
The conversations that I have with my employees, we talk a lot about the cost of living in California and already how expensive it is. And actually what I hear from them is fear that this new bill will just continue to drive those prices up, even further, whether it be rent or gas, groceries, all the kind of stuff that we all worry about and we all notice increasing. It's kind of a mixed bag. I think they're fearful that because of this wage increase, overall, all prices are going to be going up, and it's just going to compress their spending power even more. So I don't think that this is going to be some kind of, across the board huge morale boost for people, because I think they're going to realize that just how expensive everything is going to become because of this.
Does it matter, Alex, how many franchises you own? In other words, are you exempt if you only own one, or no? It impacts you regardless of how many.
As I understand it, if you're a part of a chain or a system of stores, like a franchise in my case of 60 or more locations, it doesn't matter if you yourself or my family, we own just one or 10 stores like we do, or even more than that, you're affected so long as you're part of one of those brands.
So, Alex, we've seen some case studies for all of this before, right? Because Seattle raised minimum wages. California itself, right, already at 16 is higher than some other places. And the results have been sort of mixed, right? You have seen hours cut, but there haven't been some of the sort of most dire scenarios that have been painted here. I mean, so I guess if you don't mandate a higher minimum wage, what do you do for people who are not making enough to support sort of a minimum standard of living?
Yeah, I've heard, I don't think I've seen that report that you were referencing, but I've definitely seen a lot of reports about this. And honestly, I don't have the answer. I just know that, I'm fearful, like with my business, that, people are just going to eventually get to a point where they don't want to pay $10 for a cinnamon roll or $10 for a pretzel, and then there will be real trade-offs. And that's really going to affect me and my business. I think, grocery stores and other fast food restaurants where it's more of a meal and not quite like an indulgence like my products, I think there will be more price elasticity there for folks. But, I don't know. I'm just a small business owner. I just want to do right by my people, treat them fairly, pay them as much as I can. I certainly don't have the answers on, how to solve this problem at large. But all I can control is my relationship that I have with my employees. And like I said, my family and I, we treat them really well, and we pay them as much as we can.
Alex, thank you so much for joining the show today. Appreciate your time and insight.
Thank you. My pleasure.
Time now for What to Watch Tuesday, April 2nd, starting off with Tesla. First quarter delivery results coming in tomorrow. Wall Street expecting those numbers to decline more than 7% since Q4 as Tesla continues to navigate declining EV demand.
And also General Electric are watching that. The industrial giant completing the spinoff of its clean energy business as GE Vernova tomorrow. Vernova will be trading under the ticker GEV, while the remaining company, GE Aerospace, will keep that old ticker, GE.
And moving over to the job market, the new JOLTS report for February coming out in the morning. Economists expecting that number to dip slightly, giving us more insight into labor force ahead of course, Friday's full jobs report.
And finally, we'll be getting another round of Federal Reserve commentary throughout the day, this time from Fed Governor Michelle Bowman and Fed Presidents Loretta Mester and Mary Daly. The central bank holding steady on rate cuts during its last meeting and reiterating that 3 cuts for 2024 is in line with most Fed officials. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side.
Microsoft announces a realigning of global licensing with changes to enterprise suites. Move coming as the tech giant faces an ongoing antitrust investigation in the EU. Yahoo Finance's tech editor Dan Howley is here with the very latest. Dan.
That's right, Josh. They're essentially pulling Teams away from Microsoft 365. And so rather than having Teams built into the app, you're going to have to purchase it separately. This is as a result of some antitrust kind of inquiries into how Microsoft does business with Teams. It's been getting some heat from competing companies, including Salesforce, which owns Slack, which is a competitor to Teams. Microsoft had started putting Teams into its Office suite of programs around the pandemic. It basically had replaced Skype and become a kind of video chat and text chat platform for workers. And it's taken off. It's doing well. Slack obviously not happy with that. Salesforce not happy with that. The fact that it's part of the Office bundle is a problem. So in the EU, they started to pull that back, and now they're going to do that globally, partially to offset any complaints from the EU saying, look, it makes it a problem for European companies that operate globally, as well as global businesses, and partially so that they can kind of get away from any issues that they may see as far as antitrust goes within the U.S. With this kind of bundling. So companies will still be able to buy teams. It'll just be $5.25 per user, and then they'll still be able to get Office 365 without Teams. Prices for that will range from $7.75 a user to $54.75 a user. So obviously, this is going to be something that Microsoft isn't happy with, but if it gets them to avoid any kind of fine, then they're going to go ahead and do it. And so they're going to start doing that after April 1st.
Dan, thanks so much. Really appreciate it. Well, still to come, cocoa prices are soaring to record levels amid supply constraints. We have master chocolatier Jacques Torres on the other side. Cocoa prices are soaring to record levels amid supply constraints. The price surge placing cost pressures on chocolate makers. To take an inside look at the sweet and sour aspects of the world of confectionery, we have master chocolatier Jacques Torres, founder and CEO of Jacques Torres Chocolate. Thank you so much for being here. Really appreciate it. So everyone has been talking about these big increases in cocoa prices. And here on Yahoo Finance, we have talked about it sort of from the commodity and from the market perspective. But obviously, this is something that we may all have to deal with from the eating perspective as well, if we're treating ourselves. How is this playing into your business? Have you had to raise prices as you've seen these costs go up?
Okay, so first, thank you for having me, and thank you, Julie, to be able to talk to you. It's very worrisome because we don't know where that's going. We don't know if the price is going to go down. My belief is that $3,000, maybe even $4,000 a ton is not enough for the farmers. So if we have a correction and if the price go up, I'm not against it. That will make the farmer happier, and hopefully they will not stop to grow cacao. The problem with cacao is you have only 2 harvests a year, and there is some crops where you can harvest all year and maybe make more money. That's why some of the farmer will cut some trees to go to something else. Cacao, especially in Ivory Coast and Ghana, are very sensitive to too much. If you get too much water, you're going to get some disease that's going to develop into the tree. Or if you don't get enough water, that's what's going on now. First, they get hit by disease, and then no enough water, and we don't have enough cacao. It looks like we're going to miss between 20 and 25% of cacao this year. So it's very worrisome, because if we don't have enough cacao, of course, the price is going to go up, and it's going to be difficult to find supply. So I don't know. Yes, again, very, very worrisome.
And Jacques, I mean, raising prices could be one lever you could pull. You could also, Jacques, you could reduce the size of your product. You know, you could make smaller chocolates. Would that ever be a possibility?
What we do when we have a problem like that, we might put a little bit more inclusion into the chocolate. So let's say that you make a chocolate bar with almonds, with hazelnuts, with pistachio, with peanuts, with whatever you're going to put into this chocolate bar. You might add a little bit more almonds, so the weight of your chocolate bar will be exactly the same, but it will be more inclusion, will be more almonds, or whatever you're going to add into the chocolates. We can do the same with the little bonbon in a box of chocolates. We can put a little bit more filling. Again, it's a question of balance, but it's also a question of economic. If your almonds are less expensive than your chocolates, you're going to put a little bit more almonds. So you're going to try to find a way to not cut the size of your product, but maybe change a little bit the composition to make the customer happy.
And Jacques, I also wonder, since your product is a more premium product, right? Are you less vulnerable than some of the more mass market chocolate makers?
I think this is a very good question. We use a lot of chocolate from the America. So we will go to Central and South America to buy our cacao beans. It might be a little bit less volatile, but remember, if the bottom line chocolates, the one from Africa, price rise, we're going to see the chocolate from the Americas rise also. The price will rise there also. I buy my chocolates more than the future in Africa, because the beans that we use are more high-end. It's just that there is less volatility, and we know a little bit more before we buy the price of the cocoa. And again, you know, having only 2 harvests, one big harvest and one smaller harvest in the world of cacao doesn't make things easy. And I am for paying the farmer more, so they will keep growing cacao, and we will be able to buy good cacao on the markets.
And then finally, Jacques, outside of chocolate and cacao, I'm curious, I mean, you've been at this game for a long time. Are there any new trends in ingredients that you're finding, or methods that you're finding particularly exciting right now?
Look, I love definitely to work with chocolates, and I love to pair chocolate with different things. I love the freeze-dried fruits. They have a lot of flavor. I do love to work with candied fruits, like candied oranges and candied ginger, product like that, which have a lot of flavor, and we can pair that with good quality chocolates. So that's something that I really love to do. And again, we're going to have to find a way to pair chocolates with product that can make the price of the chocolates, acceptable. Look, you don't have to eat chocolates every day. So if our chocolates become too expensive, we will sell a lot less. So we have to find a way to make that chocolate more affordable and keep with quality. I think that's the secrets of being successful.
Well, whatever solution you come up with, I am now craving a treat. Jacques Torres, thank you so much. Really appreciate it.
Nice talking to you. Merci beaucoup.
Merci
Thank
à
you.
vous. Thank you.
Merci.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern. Josh is laughing at my friend here. Your coverage.
Better than I could do. Better than I could do.
Have a great day, everybody. We'll be back tomorrow.
Fusion energy has long been hailed as the holy grail because of its potential for near limitless amounts of clean energy. But that potential has trailed reality for decades, with billions of dollars in research leading to few breakthroughs. Now there's optimism that's about to change, with startups funded by big-name backers including Sam Altman, Jeff Bezos, and Bill Gates. I went inside one fusion reactor to explore the challenges of bringing this technology to commercial use for our latest episode of Next.
When this machine gets turned on, it'll be one of the hottest points in the solar system, if not the hottest point. It's hotter than the core of the sun. A little bit toroidally positive of the center of the chimney.
What we're working on here is building our own version of a star on Earth.
Imagine if humankind could harness the sun. That's the potential for fusion energy.
It's a goal that's eluded researchers for decades, but that promise of fusion energy has investors placing their bets. The industry's attracted $6 billion in funding, with Bill Gates and Jeff Bezos part of a growing list of backers. The U.S. government set aside nearly $1.5 billion for fusion research in 2024 alone, a record amount.
It is the holy grail. Energy without harmful carbon emissions, without radioactive waste. Fusion technology could be disruptive at an even bigger level than the internet. The only thing is, we don't have a breakthrough yet.
A breakthrough resulting in clean and unlimited amounts of energy.
Success in research labs like this are critical, with more than 40 companies looking to get fusion power on the grid globally. We were invited in for an exclusive look.
So D3D is the largest operating fusion reactor in the United States. We're doing the fundamental research to figure out how we can create a nuclear fusion power plant in the future.
You ready?
Yep. Lower hybrid.
0 degrees.
Nuclear fusion is extremely difficult to do.
Okay, other direction.
Do a double shot at the bottom hole. Thank you very much.
3 seconds, 2, 1, shot in progress.
The race is on to actually see who can develop this and who can get it to the masses the fastest.
When you go inside the machine, it's always a very interesting experience.
Before you go in, the first thing you have to do is get suited up. Got a hairnet. Don't want to leave anything behind the reactor. These are dosimeters to measure radiation exposure. To get in, it's a little tight. You have to squeeze in.
The stakes are high inside this vacuum chamber known as a tokamak.
So we're not on the center. Keep going right there, right there, right there. Other axis. That's actually pretty dead on.
All right, sweet.
Tucked inside the country's largest magnetic fusion facility, researchers here are attempting to create a star on Earth.
Like so.
Chasing the promise of clean energy through a process called nuclear fusion.
The word nuclear can be scary. There's definitely a lot of confusion between traditional nuclear power, so nuclear fission, which we currently have today, and nuclear fusion. Nuclear fission takes a very large atom, splits it apart.
And the way fusion works is we're going to take 2 atoms and we're going to smash them together.
And when they fuse, they convert some of their mass into energy. So Einstein's famous E = mc² equation. Nuclear fusion generally only happens in stars, where it's contained by the gravity of its own mass. Here on Earth, what we do is we use strong magnetic fields to create a container called a tokamak.
The temperature inside the machine is about 10 times the core of the sun.
If you were to make this super hot fusion plasma and it were to touch the wall, then the wall would be immediately vaporized. The idea behind the tokamak is that you're going to make a bottle out of magnetic field, so that way this super hot fusion plasma never touches the walls.
We know how to do fusion, but we just can't do it efficiently enough to get more power out than what we put in.
And that's the key to making fusion commercially viable, finding a way to generate more energy than scientists used to create that fusion reaction.
Last week, scientists at the National Ignition Facility achieved fusion ignition. This is one of the most impressive scientific feats of the 21st century.
Researchers at Lawrence Livermore National Laboratory achieved that energy gain 2 years ago, but that reaction lasted less than 1/billionth of a second, and it was done using lasers, unlike a tokamak, which uses magnets.
When NIF, the National Ignition Facility, achieved ignition, they used very powerful lasers to create a reaction in a very small capsule, and that perhaps has difficulties scaling up. Whereas what we do here, which is use very large-scale, powerful magnets, seems to have a clear path towards a nuclear power plant that could power your home.
Those here at D3D are trying to unlock that same breakthrough using magnets with funding from the Department of Energy. That development could pave the path to commercialization.
And this is where this very healthy university, U.S. national laboratory, and private industry partnership comes into play.
Right now, D3D is an event. What that means is the machine is not operating on a daily basis, but what that means also is that we're upgrading a lot of systems.
During this upgrade period, we're installing new systems so that in the future we can test new regimes of science. So for the first time, we're testing a new technology that could improve the heating of the fusion reaction.
All right, you ready?
Got the head. And I've got the tail. For the first time, we put these modules into the machine.
That's one.
One down, 8 to go. This system will improve the stability of the plasma. The plasma fills this volume, and for fusion to happen, you need a hot, dense plasma. And this system helps increase temperature. It adds energy to the plasma and improves stability so that we can have more fusion reactions occur. This is a system that could play a role in designing a future nuclear fusion power plant.
The process of getting there is an expensive one. Billions of dollars just to build the reactors.
So what we're going to do is we'll take this out here, and then we'll slide this rod in here.
But big-name investors are lining up to fund the research because a potential breakthrough could transform industries. Just think, limitless energy, no fossil fuels, no carbon emissions. Which is why you've got Google and Chevron, Bill Gates and Sam Altman, Jeff Bezos all placing their bets. D3D isn't looking to commercialize this technology. It's laying the groundwork for it.
So when D3D is ready to go online, the tokamak's going to get closed up. We're going to turn the machine on.
Starting setup for shot 555.
There's a couple countdown timers.
3 seconds, 2, 1. Shot in progress.
And then at time 0, everything starts. And you can hear out in the power yard, you can hear a lot of the big electronic equipment making these sounds, these pulsing sounds. Magnetic fields are turned on. We inject gas, and that gas then turns into a plasma.
We put in about 20 to 40,000 homes worth of power just to make this fusion plasma hot. And then on top of that, we shoot in electromagnetic waves, and each one of our 7 sources puts in about the equivalent of 1,000 home kitchen microwaves.
We call our plasma discharges that we have shots. They last 5 to 8 seconds.
And then it's over. We're going to collect all this data, and all the science teams are going to work together to figure out what it means.
Those seconds may seem short, but it's an eternity for fusion technology. The challenge is to control those reactions long enough so they can sustain the plasma for much longer, months at a time for a commercial power plant.
The perennial question for what we do here is when you will have power on the grid. I've seen estimates within the next couple years for some of these startups to 2050 and beyond.
Roughly 24 other reactors are racing to be first. In France, 35 countries have joined forces to build the world's largest fusion reactor, with a price tag of $20 billion. But so far, progress has been slow.
You know what I mean? Yeah, so we have this guy's a reticle, that guy's a reticle, this way, right? And then you just adjust whatever you have to on this guy.
As research labs like D3D aim to achieve new milestones for energy output, larger tokamaks under construction are looking to extend the length of fusion reactions. At Commonwealth Fusion Systems, an MIT spinoff backed by Google and Bill Gates, researchers hope to fire the first shot in their reactor later next year. ITER in France is expected to come online later this decade.
With climate change looming, I think the desire for a technology like nuclear fusion is only going to grow.
There's a lot more willingness to talk about unproven types of renewable energy like fusion because we're running out of options. And so you're seeing fusion research appear more and more at these global summits like COP28.
Fusion may turn out to be just an enormous game changer.
You're seeing politicians like John Kerry talk about it. You're seeing international groups of research come together with promises of funding from various governments.
The potential for fusion energy is that we power the world's energy needs for millions of years without harmful environmental impacts.
This is a long-term project that could save humanity. The existential question is, will it be ready in time?
Microsoft has already signed a deal with Washington-based Helion to buy electricity powered by fusion energy in 4 years. The company says it's on target to have a commercial power plant operating by 2028, generating enough electricity to power 50,000 homes And that could just be the beginning. Bloomberg Intelligence estimates the valuation for fusion energy is likely to grow to $40 trillion if it captures just 1% of the global energy output.